Okay, so we're doing a follow-up session about transaction structures with Eugene Jakubov, the strategy director at CBS, Canadian Business and Enterprise Services. They offer corporate and incorporation services with complete support from registration and incorporation to contracts. And Eugene is also a transaction lawyer, so it'll be very interesting to hear what he has to say. They operate out of Toronto, Canada, but about 60% of their customer base is international. Yeah, lovely to have you here.
Hi, Lynn. Yeah. Thank you for having me back. A pleasure to be here again.
Yeah, my pleasure to have you back here. That's great. And last time we spoke about equity transactions and equity sales. And today we will focus on the asset side of things, so asset sales.
Yeah.
Um, yes. Maybe we could start off with a very short intro, just the difference between asset and share sale or equity sale.
Yeah. For most of the businesses, when we operate a business, we usually would do it as a corporation through a separate independent legal entity that will be facilitating our business operations. And that's where the difference between two transactions comes. So when we conclude the transaction as a sale of shares, we transfer everything, including the legal entity, to the buyer, leaving nothing behind for us except for the, of course, hopefully capital gains and profits that we generated from the sale itself. On the other side, the sale of asset transaction is different from the perspective that the legal entity stays. Essentially, we take all the business assets, whatever they are, tangible, intangible, equipment, list of clients, intellectual property, and we sell them to the buyer while retaining the legal entity behind, keeping it for ourselves for whatever reason and for whatever purpose we might have or might not.
Yeah, super. And could you speak a little bit more about that with understanding the assets and the different type of assets?
Yeah, so when we as business owners approach the deal itself and we see that the buyer is interested only in the purchase of our assets and we're okay with this nature of transactions, and we discussed the difference in the previous interview, um, it's very important for us to understand what is the scope of the assets that we're being selling and how to address them, how to combine them all together into a package as a part of the transaction. So, of course, every business would have certain amount of tangible physical assets that we utilize while operating our business. For some production businesses, that would be manufacturing equipment, servicing equipment, plant, sometimes real estate. For other businesses, it might be a smaller types of like a fleet of vehicles or a number of vehicles, computers, dedicated electronic equipment that's used at the office. All that falls under the termination of um, tangible physical assets. But what we have to remember is there are lots of intangible assets, in many times significantly more valuable and more important that we can sell and include in the package and also calculate the value as a part of the transaction, such as our business name, our trademarks, sometimes registered, sometimes not registered. We can have a list of clients, which again are considered to be intangible asset. Um, Certain types of intellectual property that we have registered. Trademark, I already said. It could be patent application, even pending applications could be of a high value for the purchasers, for their portfolios. We also might have copyright. Now, in nowadays, it's very important to understand that many software companies, and it's a very known fact that it's very hard to patent software developments, but the source code, which is considered to be a text and is covered by copyright protection, is a very important intangible asset that we can and might be able to sell, including the transaction.
Yeah, and I like that conversation and having that conversation between intangible and tangible assets,
Yeah.
where tangible assets are, of course, much easier to calculate the value of, whereas intangible, that's tricky, right?
Of
But
course.
nevertheless, it's super important because it can bring so much value to the business purchaser.
Well,
Um,
I always bring as an example, let's say, such companies as Nokia, as BlackBerry, as Kodak, some of which do not exist as company anymore, but their names are still worth millions and millions of dollars. So that's, for example, and that applies for every business from the smallest to the largest.
Yeah, absolutely. Absolutely. And another aspect to understand fully as a business owner selling your business is that difference between an asset sale versus an equity sale when it comes to legal liabilities and how that can affect the seller. What the obvious is how it affects right now, right? But
Yeah,
potential liabilities in the future after once the transaction has closed is also super important to understand and to identify. Maybe you could,
absolutely.
yeah,
Yeah. And so as we discussed during our previous interview, it becomes even more important for specific asset sale transaction is um, a lot of liabilities, a lot of attachments between us and different third parties, whether government or private individuals or other companies, would go through the corporation and or the legal entity through which we operate the business. And since we do not sell that entity, that individual, um, some of those attachments stay with us, and we have to. Usually, when I discuss these types of transactions with my clients, I speak about three major fields of legal liabilities that we're dealing with as business owners. So we would have regular contractual liabilities. We will have administrative liabilities, tax compliance with different local government laws and regulations, and employment. So these three fields will affect us through the corporation through which we operate the business. And since we do not sell the corporation, we retain it. We remain the directors of that corporation. All those liabilities will stay attached to us to a certain extent, and that requires a very thorough review and approach through the asset sale agreement. As a part of the agreement, although we retain the corporation, but buyer essentially buys the business, everything, and we have to cover these topics as well.
yeah, yeah, absolutely. And really, yeah, maybe build scenarios, right? In different cases of what if this happens or what if that happens in the future, and how would that affect us years down the line then, right?
Yeah, that is correct. And what is important for people to understand, there's a very basic rules. Many of them specifically say, like let's say in contractual law, we have a basic rule that is called privity of contract, which says that only the parties to the contract can enjoy or bear the liability to the contract. And what it means is that when we sold the products and sold the business to someone else, our previous obligations with suppliers, with buyers, we covered it during previous interview, the warranty that we provide, guarantees that we provide, personal or corporate, they all will stay within the scope of the contractual relationship between our company and us, essentially, and third parties. What we want to make sure is cover those and ensure that they have been duly and properly transitioned to the buyer away from us.
Yeah, yeah, absolutely. And if we would switch a little bit and look at the tax implication when it comes to an asset sale, how would you compare that against an equity sale?
That is a very important topic, and the difference in nature of the transactions affects significantly the tax attitude towards what happens and towards the cash flow in the transaction of the sale of assets. So you remember when you sell the shares, and we discussed it, you technically sell only the shares. That's your personal assets through which you exercise the ownership and control over the corporation. So the transaction would be between person A as a seller and person B as a buyer, where person A sells its shares and together with the shares the whole business. In the sale of assets, the transaction is completely different. The transaction is between company A and person B. Company sells its own assets to person B, and it could be a physical individual or legal entity, while the company gets the payment, which means we as a private individual owning the shares, we do not get the payment directly, and we do not recognize it as our income directly. In some cases, it could be good. So essentially, it will allow you to spread the income over a longer period of time, withdrawing the proceeds of that sale throughout, let's say, 4, 5, 10 years. From the other side, in certain jurisdictions, like in Canada, if I would sell shares, I would recognize that profit that I generate as capital gain, and we have up to $1 million, close to that, exempt from tax, which is called capital gain exemption. Now, in certain jurisdictions, the nature of transaction will result in me either being able to save $250,000 of income tax payable, or to pay it to the government. And
And
that's, yeah.
thanks. Yeah, and if we would compare that to the U.S., then if we're more specific on the U.S. region, what's the difference
Mhm.
there?
So again, from the taxation purpose, US is much more complex than Canada, because you're bigger. There are more states, and the taxation laws are split between federal and state laws much more differently and variably from state to state. So it's very important to get a proper advice from a tax accountant, tax lawyer, before you proceed with the transaction, to understand, especially in the asset sale transaction. So what happens is your company gets the profit from sale of assets, and the profit stays within the company. It will be capital gain, but the company will recognize it. And then you have to understand, how do you take the money out? Because every time you'll be pulling money out of your company, you will be generating personal income, whether as a dividend or any other way. And from the taxable perspective, if done incorrectly, that could become a very painful mistake. And that is why a proper advice and evaluation of the transaction from the tax standpoint is very important.
Yeah, absolutely. Absolutely correct. And also that differs from state to state here in the US. So,
Yeah.
yeah, having a proper advice and setting it up correctly from the beginning will save both dollars and pain down the
Yeah,
road.
absolutely.
Um, yeah, yeah. And about proper, when it comes to agreements, what is the importance of a proper agreement, and what's the impact if you don't have a good agreement?
So with regards to sale of assets, essentially, we're talking not just about one agreement. We're talking about multiple agreements combined into one package. So first, we have to structure properly the actual agreement where we sell the assets to the buyer. And we, again, remember your company, not you personally. Then you have to remember every single agreement that was ever signed and still is in effect between your company and your suppliers, your customers, whoever else, should be assigned to the new buyer. Every employment relationship of those employees that will continue into the buyer's team must be assigned to the buyer, with the buyer taking certain responsibilities over the employees from the perspective of length of their employment. If there are certain rights upon termination, like parachute clause for executives, or termination compensation for regular employees, all those should be, essentially, it's like assigning a new agreement. It could be simple, one pager, two pager, but when you come to the transaction of sale of assets, with the legal entity part of the agreement, contractual relationship staying with you, that would be a package, not just an agreement. Extremely important to cover these topics. Extremely important to cover employment relationships, since you don't want to end up with employees but no business to utilize them, and you will have to deal with the termination consequences. And of course, taxation, administrative liabilities, certifications, licenses, all those are usually issued for a corporation. So from the basic operations of a restaurant or small service kind of operations to large manufacturing, most of the licenses would be on the name of a corporation. There might be a person behind the license as a supporting, as a attorney for service or anything, but the corporation is the licensee. Now you retain the corporation, but the business moves out. And this is very important to cover. So these three topics, a must to cover in the agreement itself.
Yeah, yeah, absolutely. Of course, there's many agreements and contracts that go into that agreement between the buyer and the seller. And I think though those insights were really good. Thank you so much. We're coming towards the end here, but great. I appreciate the conversation. Super good to have you here again.
Thank you, Lynn. Thank you. It's my pleasure, as is usual.